In the busy streets and local markets of Kathmandu, daily life runs on cash, small trades, and community trust. Behind this vibrant everyday economy, a quiet disaster has destroyed the financial security of those exact same people. A landmark parliamentary inquiry recently revealed that 87.89 billion rupees have completely evaporated from local savings accounts. This systemic collapse reaches far beyond the failure of a single bank. Investigators have traced the missing wealth across 40 different credit cooperatives, leaving over 60,000 verified depositors with empty passbooks. These victims were retirees, daily wage earners, and housewives looking for basic financial security. They weren't seeking high-risk gambles. They were actively preyed upon by local institutions they thought they could trust. How do tens of thousands of typically cautious savers willingly walk into a trap of this magnitude? To understand the mechanism, look at the interest rates. Traditional, regulated commercial banks offered a safe but modest return of around 7%. Across the street, community cooperatives were promising high-yield fixed deposits, paying up to 17%. Squeezed by a tough local economy and rising costs of living, everyday citizens bypassed the commercial banking sector in pursuit of these lucrative, guaranteed returns. Because these local cooperatives operated strictly under local municipal rules rather than the strict laws of the central bank, they existed in a regulatory void. The government inadvertently created a space where financial predators could treat public money as their own. Without mandatory reserve requirements, cooperative directors faced zero restrictions. They immediately began using pooled community deposits as their own private capital. To maintain the illusion of success, they relied on a classic Ponzi dynamic. Early investors received their promised 17% payouts using the fresh cash physically handed over by newer depositors. As long as that fresh money continually flowed into the bottom of the pyramid, the institutions appeared healthy to the public. Behind the scenes, liquid cash was being systematically drained out of regional cities. Savings were extracted from communities in Pokhara, Butwal, and Birgunj. This extracted regional wealth was then funneled directly into a centralized, unregulated hub right in the capital city of Kathmandu. This coordinated national extraction network pulled wealth from every corner of the country, operating in plain sight for years. So where did all that money actually go? The first major sinkhole was the national media sector. The data shows that 655.4 million rupees were illegally extracted from 6 specific cooperatives to fund the launch of the Galaxy 4K TV network, operated by Gorkha Media. High-profile executives, specifically Chairman G.B. Rai and former Managing Director Rabi Alami Chane, directly authorized these illegal disbursements by signing off on the checks. To cover their tracks, they routed the funds through dummy mortgage accounts and unapproved loans that lacked any real financial backing. Public savings intended for medical emergencies and retirement were forcibly converted into corporate shares, television studio equipment, and executive salaries. Media ventures were only part of the problem. A second trap involved massive sums of capital diverted into speculative real estate, including 5.8 billion rupees stripped from the civil cooperative alone. This created a severe liquidity crisis. Accessible, liquid savings were permanently trapped inside illiquid land hoards and unfinished housing projects. The breaking point arrived when the regional real estate market inevitably slowed down. Depositors rushed to the teller windows to demand their money back, only to find the vaults completely empty. To hide this total insolvency from regulators, promoters fabricated their audit reports and invented dummy shareholders out of thin air. By officially logging fictional loan repayments on their ledgers, these schemes managed to survive for over a decade without ever triggering a regulatory alarm. By the time the market crashed, these institutions were already hollow shells, mathematically disguised as healthy businesses long after their actual bankruptcy. Today, the parliamentary inquiry has concluded, leaving victims to face a devastating mathematical reality. Investigators are looking at 87.89 billion rupees in outstanding liabilities, compared to a shockingly low fraction of assets that have actually been seized. With a recovery rate sitting below 1.2%, the vast majority of these depositors' life savings are functionally gone forever. The resulting human fallout has forced thousands of desperate victims out into the streets, demanding immediate government intervention and justice. Because Nepal lacks a structural safety net, or mandatory deposit insurance for these entities. The victims of this fraud are left holding the bag for a systemic government regulatory failure. The macroeconomic danger now is systemic contagion. This high-profile collapse is already triggering panic-driven bank runs on solvent, healthy cooperatives, threatening the sector's remaining 7 million members. To stop the bleeding, the government must mandate strict Nepal Rastra Bank oversight for all large-scale cooperatives. Integrating these institutions directly with the Credit Information Bureau is the only way to prevent promoters from hiding fake loans in the future. The question now is whether regulators can implement these policies fast enough to restore public trust in non-bank financial institutions, or if the damage to Nepal's savings culture is irreversible. What policy steps do you think are necessary to fix this crisis? Let us know your thoughts in the comments below. And for more data-driven macroeconomic breakdowns, hit the subscribe button.